What we have seen is there are now 19 states that have seen a significant increase in the unemployment rate, and that's about 40% of GDP. And whenever you've had that many states in recession, we have eventually had a nationwide recession.
On WealthTrack, leading Wall Street economist Nancy Lazar explains why recession is a looming possibility and the markets are full of risks.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Royce Investment Partners, Baird, Bill Miller, Research Affiliates, Strategas Asset Management, Women Investing in Security and Education, and Matthews Asia.
Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. They say location is everything in real estate. It can also make a huge difference in your job opportunities and income. For years, this week's guest, leading Wall Street economist Nancy Lazar, has called Middle America her favorite emerging market. According to Lazar, the advantages of business-friendly locations, energy independence, relatively low corporate tax rates, and a less competitive China have led to a manufacturing renaissance. Goods-producing states like Indiana, Wisconsin, Iowa, Alabama, and Idaho have been job winners. The recent unemployment rate in the Midwest region is 3.6%, in the South 3.4% versus 4.9% in the Northeast and 4.6% in the West. However, even with increased onshoring of U.S. manufacturing and the enormous government investments of the CHIPS and Inflation Reduction Acts, Lazar says Middle America cannot escape the national headwinds of higher interest rates, tight bank lending standards, and higher wages and prices. Nancy Lazar is the chief global economist at Piper Sandler, where she leads the economic research team. Before joining Piper Sandler, she was chief global economist and head of economic research at the highly respected independent macro research firm Cornerstone Macro, which she co-founded in 2013. Prior to Cornerstone, she was co-founder and vice chairman of ISI Group for more than 20 years. Lazar has been an institutional investor-ranked economist since 2001, placing in the top 2 the past 10 years and ranking number 1 in 2015. She has also been on Barron's 100 Most Influential Women in U.S. Finance list in each of the last 5 years, including this year. I asked Lazar why she has raised the risks of recession to over 50%.
We do think there is a very high probability of a recession, really for 3 simple reasons. 1, the lagged effect of the Fed tightening cycle. 2, higher bond yields. And then 3, banks have been tightening lending standards. We have used those 3 concepts forever in our economic analysis. And when they are all pointing in this direction, when banks are tightening lending standards and you clearly have higher interest rates, you've never had a soft landing, you've always had a hard landing. Now, sometimes it takes a while. On average, it takes 10 quarters after the Fed raises rates before you get a recession. Right now, we're in the 9th quarter, but it can range. It can be as much as 16 quarters. And so we just think this is a very risky economic environment, given how high interest rates have gone and how significantly banks are tightening lending standards. And you're actually already seeing some parts of the economy that are really, really struggling. We call it a bifurcated economy. You have small businesses that are in recession territory, the NFIB index it's called, National Federation of Independent Business. Survey of small businesses is very deep in recession territory, weaker than it was in 1990-91 recession, weaker than it was in the 2001 recession. Not as bad as it was in the GFC, but it's pretty weak. And then second, as a very bifurcated economy for consumers. The high-end consumer, middle-end consumers have been benefiting from a high stock market, a decent house price, obviously, backdrop, if not a strong house price backdrop. They don't have to get new mortgages. They have a 3% mortgage. They're not being struggled in finding affordable housing. They already have affordable housing. But the low-income consumer is in recession territory. Wage gains in that sector have slowed. Price levels have stayed elevated. Their credit card debt is through the roof. We just got a new reading on auto delinquencies. Subprime auto delinquencies are at a record high. And so we have a very bifurcated economy, unstable economy. That coupled with what we've suggested, those higher rates are making a difference. They've just not yet touched the higher middle income consumer or big businesses. And we would say, be careful, they will.
So where's the risk and what is it that could tip the economy into recession?
It really is that middle income consumer.
Yep.
They are the tipping point. They are the group that are the big drivers of consumer spending, and therefore they're the big drivers of economic activity. And what you really need to see to get them to pull back is a clear increase, a significant increase in the unemployment rate. And you've not seen that yet. The unemployment rate needs to increase to something over 4% before we really start to negatively impact that middle income consumer. They also have a lot of consumer installment debt. They've been using their credit cards. And so if you do see the unemployment rate clearly increase, they are going to have some credit problems because they have also been using too much credit card debt where interest rates are over 20%. It's quite a negative backdrop for those that have been using their credit cards.
But why has it taken so long to actually hit like middle income consumers?
So we had an unprecedented amount of liquidity injected into a healthy economy, if I can use that phrase. We had obviously a lot of sickness, but the economy was healthy going into the crisis. This was not a GFC where we had a banking system which was destroying liquidity, and we needed to have massive amount of QE just to keep the economy out of something even more severe, depression-like scenario. This economy was full throttle prior to the COVID crisis, and they added massive amount of money, and we call that legacy liquidity. First, it boosted sharply corporate revenues, and then those corporate revenues, companies hire people, then companies started to rehire everybody, and they ended up having to pay bigger wages, but their revenues are so high that they've not had to really fire people yet, because what we call compensation, what they pay people to work relative to their revenues is still historically low. And companies are very sensitive of trying to protect their profits. And if they start to see compensation ratios rise, then you start to see layoffs increase significantly. That's not happened yet because of the legacy. Although the Fed is tightened, although the budget deficit has stopped deteriorating, that liquidity is still in the private sector, and therefore the unemployment rate hasn't yet gone up significantly because companies haven't seen their profit margin squeezed. We think between now and the end of the year, say by the fourth quarter, those revenues will start to clearly deteriorate, and then you will start to see a clearer increase in the unemployment rate, taking down that middle income consumer.
You know, this is so contrary what you're saying to what, Jerome Powell has said and what the Fed is saying about the state of the economy being strong, unemployment being low, and it's still the expectation that eventually, we will get some rate cuts, but without sparking inflation. What's your view of what the Fed's picture is?
Well, obviously, we're not as optimistic as the Fed is as far as being able to achieve a soft landing. I'm not saying the Fed is political, but it is a political backdrop. It is an election year, and everybody in Washington knows if you have a recession in an election year, the incumbent has always lost. So one, it's an election year. Two, the Fed doesn't seem to want pain. That is, we had the banking turmoil last March. They immediately provided extra liquidity to that particular group. That did eventually lead to an easing of financial conditions. Bond yields came down, stock prices went up. And we are a little concerned that policymakers in general in Washington are very focused on keeping easy financial conditions. And what I mean by easy financial conditions is, quite frankly, preventing an increase in bond yields, a significant increase in bond yields, and then also obviously try to cushion any blow to the stock market. And they did that last fall, actually in the fourth quarter. Janet Yellen reduced the duration of Treasury issuance. Chair Powell opened the door to pivoting, and those things did ease financial conditions, and net is helping to keep the economy stronger. So combination of legacy liquidity, lagged effects of the massive stimulus that we got in 2020 and 2021 is still in the private sector hand, not in the low-income consumer, but in that middle to high-income consumer, coupled with policymakers really wanting to keep the stock market going and bond yields from going significantly higher.
At this point, the elections in November, is there anything policy-wise that the Fed or the government can do to, prevent the economy from going into the recession that you think is a better than even chance of doing by the end of this year?
I think they just could delay it by some of these actions. the CHIP Act grants that have been handed out to companies. The CHIP Act is to lure semiconductor companies to building factories in this country. It's been interesting that since December, there's been at least one grant announced by the Biden administration every month. And that net helps to support those companies. That net helps to support the stock market. So I call it stealth stimulus through unleashing some of the programs that have already been announced. So I'm not sure any policy change can affect the outcome, but there can be these stealth measures to protect financial conditions.
Sure, and student loan forgiveness is another huge one.
Absolutely.
The chances are we'll see more of those. It's so interesting that that Jerome Powell and the Fed has been adamant about saying that they are not affected by politics, and that they're totally data dependent, and they're going to do their job. And it's like they're saying we almost have blinders on. And does that square with what you see them doing?
Well, they did tighten very significantly. They did raise rates very
Yes,
significantly.
they did.
This last meeting, when they announced the sharp cutback in quantitative tightening, the amount of Treasury securities that they're taking out of the economy, they're cutting that back dramatically starting in June. And that, to me, doesn't seem consistent with this idea that we need tight financial conditions to make sure we squeeze out this inflation, that it's not just a temporary lull and that it could reaccelerate. So I'm not the Fed watcher in our group, but I do worry about some of their actions actually not keeping enough liquidity out of the system to make sure we go into this recession and we get a higher unemployment rate, and that then gives us a sustained shift down in inflation. I've studied the late 1960s a lot, which is where you laid the foundation for the inflation of the 70s. And there are some similarities today with that particular period. A lot of political pressure for the Fed to ease. In 1966, you had a stock market decline, you had a credit crunch. The Fed eased with a sub 4% unemployment rate. The stock market loved it, but bond yields halfway through the easing cycle said no way, because inflation picked back up, the unemployment rate went back down. So I am a little worried that in order to get a sustained shift down, we need, unfortunately, it's this sustained shift up. That short-term pain for longer-term gain versus short-term, keeping the economy stronger for longer. I do worry that inflation is a bigger problem down the road.
To get back to Middle America being your favorite emerging market, which has really been a great theme, very successful theme that you've had for I think over a decade, at least. But in some recent reports, you've mentioned that 19 states are in recession, and some of them are these manufacturing hubs. So tell us what's going on there.
So again, I feel like I'm building a puzzle that's titled a recession. And we are looking for signs or not of the economy tipping into a recession. And so we monitor unemployment rates by individual states. And there's something called the Sahm rule. Claudia Sahm, a now famous economist who used to work at the Federal Reserve. And the metric is if the unemployment rate increases about 50 basis points, 0.5 percentage points, that using 3-month average data, sorry for the minutia, but it is important, that those states go into, the overall economy eventually goes into a recession or is in recession when that Sahm rule is triggered for the entire economy. What we have seen is there are now 19 states that have seen a significant increase in the unemployment rate. And that's about 40% of GDP. And whenever you've had that many states in recession, we have eventually had a nationwide recession. So it's a piece of the recession puzzle that you've had these increases in these 19 states in their unemployment rates, signaling that yes, the odds of a recession are growing.
So countering that, however, is you've been talking about the manufacturing renaissance, and also that with the CHIPS Act and the Inflation Reduction Act and all of the stimulus that is going to manufacturing, you're calling it manufacturing renaissance on steroids.
Very interesting phenomena we've seen over the past several months. We're starting to see a decline in companies expanding domestic capital spending. I've noticed it in some of the earnings reports, some of the industrial earnings that have been coming out over the past few weeks. You've seen some of their earnings disappoint, and it's corresponding with a shift down in capital spending. So capital spending is on steroids, and I use that word on purpose because obviously that's not healthy. Steroids are not healthy. They give you a short-term boost, and eventually they come back and hit you over the head. Now to see these anecdotes of companies are seeing disappointing earnings fits with our calculations of capital spending going on in the United States. So we actually are seeing early signs of a shift down in CapEx. Why? Lagged effects of higher interest rates. Egregiously, the reason I use steroids, egregious price increases in the construction of these factories with all the stimulus money. Unfortunately, we've seen a surge in the cost of building factories, and companies are saying, geez, these are over budget. I may not be able to build as many factories as I had planned. So unfortunately, I'm a little concerned that this massive, quick speed of stimulus that was added to the economy was too much. We don't have enough supply. We don't have enough capacity. And when you do that, when demand exceeds supply, you get prices going up, costs go up. So it's not just in the consumer side you've seen inflation, it's also on the industrial side, and both need to be slowed significantly to make sure we don't revert to, say, a period like we did in the late 1960s.
Talk to me about how important the middle income consumer is and what you're watching to determine whether or not, in fact, the middle income consumer is reaching recession territory as well.
So the middle income consumer is the driver of overall consumer spending. They create the big swings in consumer spending. What we're going to be watching most closely, there are several measures of consumer confidence. The University of Michigan has one, the Conference Board has one, and if you use the University of Michigan's, they've got a lot of historical data. We look at the three tiers of income: high income, middle income, and low. It's going to be very difficult for that middle income consumer to stay confident with a deterioration in the job market. Once the unemployment rate goes up, middle income consumer confidence clearly goes down. It hasn't happened yet, but we think it will happen as we move through the year, more likely in the fourth quarter.
Recently, and recent reports have talked about how there's a lot of risk in the markets. So how risky, and I'm assuming you're talking about the equity markets. Are you also talking about bond markets?
We do think there's risk in both markets, both equity and in the credit markets, once you move into this weaker economy. One, in the equity markets, companies have been dependent on price increases to support their revenues and their earnings. This is unprecedented in our day and age. The last time you saw that, it was, again, way back in the mid to late 1960s when you were ramping up, beginning to ramp up inflation. Nothing like we've seen over the past 30 or 40 years, where companies have been so dependent not just on selling individual products, but also correspondingly raising prices. If we have a recession, inflation will slow, and if inflation slows, you're going to squeeze profit margins, and that creates risks for the stock market. On the bond market, again, similarly, corporate revenues have been bloated because of these price increases, and so corporate interest expense ratios have been low, but those are also going to go up once revenues start to at least stall out, if not actually outright decline, which is what our models suggest.
So, you talked about the indebtedness of the low-income consumer. The U.S. government has a tremendous amount of debt that they need to refinance at higher rates. How much of a concern is that to you?
Very a huge concern to the long-term health of the U.S. economy. To have a budget deficit of around 7%. With a sub 4% unemployment rate is just totally irresponsible. Again, that low unemployment rate highlights how much liquidity they've injected into the economy, and which gave us these huge deficits. There's nothing more detrimental to potential GDP growth, which is the combination of productivity and ability of people, labor force participation, the ability of people to rejoin the labor market in a lower interest rate environment. Once you have a huge government deficit, you crowd out the private sector, rates stay higher for longer, it limits the beneficiaries of any economic growth that we have, it destroys productivity, destroys profit margins, destroys labor force participation, and it's totally underappreciated right now, we would argue, in the popular press on how dangerous these big budget deficits are.
There are a lot of expectations that the Fed will come in to the rescue again in the case of a slowdown. What kind of influence can the Fed have to basically to avoid what you see, slowly unfolding?
The Fed always eases going into a recession. The 2001 recession is the most obvious one, yet you still had it because the lagged effects of those higher interest rates pushed the economy down. Could they potentially temper the severity of it if they were to do massive QE again? Yes, but we think the damage is done.
How does the rest of the world look? How do other economies look compared to the U.S.?
We have a very bifurcated, if I can use that word again, bifurcated global economy. Japan, the economy there is quite solid after struggling for many decades, but their interest rate structure is too low. I am concerned that they risk inflation staying higher for longer in that economy. You are seeing that translated into a extremely weak currency, which is coming back home and keeping our currency on the stronger side. Europe's basically muddling along. You have today the peripherals, the Spain, Italy, Greece are actually doing incrementally better than, say, Germany. Quite the change from a decade ago. They're certainly being boosted by tourism, and because the euro there is also depressed. Germany is just an overregulated, not a very attractive place for companies to increase their investments. And so, at the end of the day, that economy is struggling. France is kind of in the middle. They do have the Olympics this summer. China is, we think, the Japan of the 90s. We don't think we're going to have a crisis out of China, but it's got a massive real estate bubble. We took a hit in 2 years unwinding our real estate bubble. Japan took a decade unwinding theirs. It looks like China's going to take at least a decade. And so it's just going to muddle along. We think they're not very friendly to Western investors or Western companies. We think that's pretty much uninvestable. India's picking up some of the slack. Mexico is also, Mexico would probably be our second favorite emerging market as we look forward, but a very, very bifurcated global economic backdrop.
Right. And why would Mexico possibly be your second favorite emerging market after Middle America?
Because they're also benefiting from onshoring. There are some production that can be done cheaper in Mexico than it could be in the United States. So they are also incrementally receiving onshoring. Unfortunately, also from China, and we're a little worried about that longer term.
Why are you worried about China basically starting to build factories in Mexico?
It's becoming increasingly obvious that the tariffs that we've put on China, both the Trump administration and the Biden administration, they're trying to go around those tariffs. And one way they can go around them is by building facilities in Mexico and then exporting them from Mexico into the United States. And there are early signs that that is exactly what's going on. We're not supportive of tariffs. That is bad economic policy, but both parties seem willing to do it.
Nancy, one investment for a long-term diversified portfolio, and I'm going to congratulate you because the last time you were on a year ago, it was the Dow Diamonds ETF, which is up 20% in a year. So what would your one investment recommendation be this year?
Well, again, given our concern about the profit margins and earnings outlook, we might think about saving a little money on the sideline in cash. I'm not sure in my 40-year career I've ever really said that. I am more worried about sticky inflation and that if policymakers don't respond quickly at the end of the day and if they somehow keep the economy stronger longer. Now, the market actually doesn't mind inflation, and so the market may continue to go up with these easier financial conditions, but the eventual decline in the market could be more severe as a result of a higher unemployment as a result of the tightening cycle that lasts a lot longer than is currently anticipated.
So a little stash of cash.
Well put. A little stash of cash may not be a bad idea right now.
All right. Nancy Lazar, so great to see you and have you in WealthTrack again. Thanks so much for joining us.
Thank you very much.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is invest in freedom. There is a growing body of research that shows that markets in democratic countries outperform autocratic ones. A research paper, Democracy and Stock Market Returns, examined the relationship between the level of democratization and stock index returns in a sample of 74 countries over a 40-year period. Its conclusion, autocratic states are characterized by lower returns. The paper cited lack of legal protections for investors and business and risk of expropriation as the major causes for the underperformance. In a paper titled Shorting Socialism, put out by the global asset management firm Verdad, their research found that market returns have been lower in Latin American countries governed by socialists. Verdad's investment view: we continue to believe that investors trying to discern where to invest their capital over the decades should significantly discount markets that seem prone to policies advancing objectives that are mutually incompatible with those of capitalism. In other words, where you invest matters. Democracies governed by the rule of law are better for investors, and there is more and more research to prove it. Next week, a way to invest directly in freedom. Perth Toll, the founder of Life and Liberty Indexes and creator of the Freedom 100 Emerging Markets ETF, joins us to discuss her groundbreaking and benchmark-beating invention. In this week's extra feature, Nancy Lazar shares the reasons she is convinced that China will not usurp the United States as the world's most powerful economy. For those interested, please follow us on Facebook, X, and our YouTube channel. Thank you for your time and attention. Have a lovely weekend, and make the week ahead a healthy, profitable, and productive one.